What if I told you the world's biggest financial disasters, meltdowns that wiped out pensions, destroyed jobs, and destabilized entire nations, weren't just predicted by banks, but profitable for them? What if the same institutions that warn us of risk quietly position themselves to win when everything else loses? And what if this isn't an accident, but part of a repeating cycle that has played out for more than a century? A cycle so predictable that once you understand it, global crises start to look less like unexpected shocks and more like business models. Today, we're uncovering the hidden financial mechanism, almost a ritual, that quietly turns global crises into banking profits. A cycle that governments fail to break, regulators fail to control, and ordinary people fail to see coming, until it's too late. But to understand how this cycle works, we need to rewind to its origins, to a time when modern finance was young, when the rules were still being written, and when a handful of bankers discovered just how lucrative disaster could be. The story begins in the early 20th century, long before digital trading, long before modern risk models, back when finance was raw, chaotic, and astonishingly unregulated. But even then, a crucial pattern emerged. Every time markets fell apart, whether because of war, crop failures, gold shortages, or pure panic, banks noticed something. Liquidity dries up for the public, but demand for credit spikes. People will pay almost anything for stability when the world feels unstable. And so the earliest version of the crisis profit cycle emerged. Build up risk during good times, let the system become fragile. When collapse comes, lend at higher rates, buy distressed assets, and expand influence. This wasn't necessarily deliberate at first. It was simply a side effect, a financial reflex triggered by panic. But reflexes can become strategies, and strategies can become systems. By the 1920s, the United States was experiencing an unprecedented boom, a boom fueled by speculative borrowing, often encouraged and funded by major banks. Margin loans, installment credit, corporate expansion, massive leveraged bets. Banks profited enormously. But when the bubble burst in 1929, something strange happened. Yes, thousands of banks failed, but the largest institutions, the ones with liquidity, political connections, and aggressive acquisition strategies, emerged from the wreckage bigger and more powerful. They bought competitors for pennies. They scooped up real estate at auction. They acquired assets the government wanted stabilized. They became indispensable. For them, the crisis was not an ending. It was the start of a formula, the first version of the cycle. After the Great Depression, governments around the world promised to break the cycle. They created central banks, regulation, deposit insurance, and oversight. These reforms worked, at first, but they also created something new, a paradox that would supercharge banking profits. Because now, banks had safety nets for when things went wrong, freedom to innovate when things went right, political leverage because they were too essential to fail. Slowly, quietly, the incentives changed. Banks began to understand. If they made safe loans, they made small profits. If they made risky loans, they made large profits. And if the risks blew up, central banks would step in to stabilize the system. The risk was socialized. The reward was private. This wasn't corruption. It was a structural design flaw. By the 1970s and 80s, deregulation, globalization, and new financial instruments, like derivatives and securitized loans, poured jet fuel on the fire. Banks were no longer just reacting to crises. They were creating the conditions for them. Because the cycle had matured into a full, self-reinforcing loop, the crisis profit cycle. Modern version. Innovation phase. New products expand lending and risk acceleration phase. Profits surge, leverage rises, oversight loosen, fragility phase. Risk becomes systemic, but invisible to the public. Crisis phase. Markets collapse, governments intervene. Harvest phase. Large banks buy distressed assets, gain power. Reset. Regulations are added, then slowly eroded repeat. If this sounds familiar, it should, because the most dramatic example of this cycle was about to arrive. The origins of the 2008 crisis are well documented, but what's less discussed is how perfectly it followed the crisis profit cycle. 1. Origins. Cheap credit plus new products. Mortgage-backed securities, credit default swaps, and artificially low interest rates created a risk-free illusion. Banks made record profits pushing subprime loans. 2. Rise. Regulatory blindness ratings agencies stamped toxic securities as AAA. Politicians celebrated rising homeownership. Investors chased yield. Banks knew the system was fragile. Internally, many called it a ticking time bomb. But as long as they could package the risk and sell it, the profits were too good to stop. 3. Breaking point. When mortgage defaults began, contagion was immediate. Financial institutions worldwide began to topple. 4. Fallout. A global near collapse, millions lost homes. Trillions in household wealth evaporated. Unemployment soared. But then came the most important part of the cycle. 5. Harvest phase. Governments stepped in. Central banks pumped trillions in liquidity into the system. Bailouts saved major institutions from collapse. Interest rates dropped to near zero. And what did the largest banks do? They consolidated the industry. They bought up competitors. Their stock prices surged. Their power grew. By 2013, just 5 years after the crash, the top U.S. banks were larger than ever, and their profits exceeded pre-crisis highs. The cycle was complete. And more importantly, it was now undeniably visible. After 2008, regulators around the world claimed the cycle would be broken. Too big to fail would become never again. Stress tests, liquidity rules, capital requirements, all redesigned. And yet, within a few years, loopholes appeared. Regulations softened. Lobbying intensified. Risk moved into shadow banking, private markets, and fintech. By the mid-2000s, leverage was rising again. Corporate debt ballooned. Derivatives markets reached new highs. Banks returned to record profits. Banks insisted the system was more resilient than ever. But the ingredients of a new cycle, cheap money, complex products, political pressure, were already in place. And then, the world was hit by an unexpected shock. When the COVID-19 pandemic hit, economies shut down overnight. Markets collapsed. Fear skyrocketed. A perfect storm. But then something unprecedented happened. While unemployment soared and small businesses struggled, bank profits sharply rebounded, then hit historic highs. Why? The cycle. 1. Crisis phase. Markets panic. Liquidity freezes. Governments intervene. 2. Intervention phase. Central banks slash interest rates to zero. They inject trillions into the financial system. Asset prices rebound at record speed. 3. Harvest phase. Banks lend cheaply but profit from fees, trading, and asset inflation. Wealth inequality surges. Housing prices skyrocket despite economic hardship. This wasn't a coincidence. It was the cycle working exactly as designed. But here's the more shocking part. The cycle didn't just survive the pandemic. It accelerated. Since 2021, global debt reached all-time highs. Bank profits in several regions hit multi-decade records. Speculative markets boomed, AI-driven trading compressed risk into new forms. Private equity expanded into essential sectors like housing, new asset bubbles, crypto, tech, real estate, swelled simultaneously. And yet, despite multiple warning signs, the system keeps pushing forward. Because the incentives remain unchanged. Banks still profit enormously from risk. Governments still rescue the system when it breaks. Consumers still bear the fallout. Different era. Same cycle. Let's look at the numbers that bring this cycle into focus. Since 1980, every major financial crisis has been followed by record bank profits within 3 to 5 years. Global wealth inequality spikes immediately after crises, then stabilizes at a higher level. The top 0.1% increases its share of assets faster during downturns than in expansions. Bank consolidation accelerates during crises, shrinking competition. Government interventions overwhelmingly protect financial institutions, not households. Post-crisis regulations decay within a decade, reopening the same vulnerabilities. These aren't random coincidences. They are symptoms of a structural loop. The crisis profit cycle survives because of four powerful forces. 1. Misaligned incentives. Risky behavior delivers short-term rewards, and the consequences are socialized. 2. Regulatory memory loss. Public outrage fades fast. Lobbying pressure does not. 3. Global interdependence. Modern finance is so deeply interconnected that governments must intervene to prevent collapse. This creates a permanent safety net, no matter what policymakers claim. 4. Complexity as a shield. The system is now so complex that very few people truly understand how it works, including regulators. The result? A cycle that has repeated for over 100 years and shows no signs of stopping. So what does all of this mean? Here are the three core takeaways. 1. Crises are not only predictable, they're profitable if you're a bank. The system is built in a way that rewards high risk during the boom and provides protection during the collapse. 2. The more complex the financial system becomes, the easier it is for the cycle to continue. Innovation outpaces regulation. Risk hides in new corners. And by the time we notice a bubble, it's already systemic. 3. Ordinary people pay the price for a cycle they didn't create. Lost homes, lost savings, lost economic security. While the institutions that caused the damage emerge stronger.